Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
Bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
With all the uncertainty out there in the stock market, bouncing around, is there a way to participate in any future gains of the market but not lose everything? If the bottom were to fall out? Well, there could be, and it's called an annuity, and annuities are getting popular again, according to an article recently in ARB, but I don't think there's a financial product surrounded by more confusion and misinformation than annuities. You hear some good things about them, you hear some terrible things about them. But what's the truth? What should you do? What do you need to know? Keep it here, as I'll be discussing today with you what you need to know about some of today's most popular annuities. Good morning. I'm David Hollander, and this is Protect Your Assets Radio. For those of you just joining us, you heard the jingle. Welcome, people around here. They call me the Sandman. If you have a question, something comes up during the week, you need some help, email me, questions@PYARadio, stands for Protect Your Assets, questions@PYARadio.com. So, should you consider adding an annuity to your investment portfolio right now? Well, you might. You see, there are types of annuities that allow you to participate in different indexes of the stock market, like the S&P 500, and still protect or insure, backed by that insurance company, the downside if the market were to go down. So today I'll cover 5 ways annuities could help you out. Now, let's get started. Well, the Fed met this week and they held rates steady in the market. The Dow was off just slightly at 0.4%. Year to date, we're up 1.7%. S&P up a little bit, 0.3%. Year to date, we're up 1.4%. NASDAQ was off slightly, 0.2%. The MSCI International EAFE Index, well, that was up 1.4%. And the 10-year Treasury held flat at 4.25%. Oil had a very good week, up 7.7% this week. And year to date, it's up 14.5%. The Fed met, as I was talking about last week, and they held rates, I'm sure you heard, flat. So the Fed fund rate is at 3.5 to 3.75. They like the growth in the economy, saying it's still at a solid pace. Big news this week was President Trump's nomination of Stanford professor Kevin Warsh to succeed Chairman Powell on the Fed. Warsh was with the Fed, you may remember, during the 2008 recession. He's also a more broader perspective, meaning he'll look at other things to forecast inflation. But remember, the confirmation process could take some time. And if it goes past the May 26 term of Chairman Powell, then Philip Jefferson, the vice chair, would take over for Chairman Powell as the chairman. Powell still will be on the Fed until January 28. That's when his term expires, and he hasn't said what he's going to do. But remember, the Fed is made up of 12 different people, and each one has their own equal voting power. So we'll see what happens. Fourth quarter earnings season hit its stride last week. More to come this week with the Magnificent Seven companies, Apple, Meta, Microsoft, Tesla reporting. All estimates beat. The reaction in the stocks, well, it was kind of mixed. We saw Microsoft down a little bit this past week. And the concerns, again, we keep hearing about capital expenditure, spending to increase cloud computing power. That's tied to AI. What about the government shutdown? Well, it's shut down, that's right. And they will get back together again Monday to vote on this budget to extend that out to September of this year. And the issues appear to be ICE, funding, and things like that. So we'll see how they resolve it all, but it's still up in the air. If you have excess cash right now might be a good time to start looking at some quality bonds and or equities that could align with your goals or your comfort for risk. Speak with your financial advisor who can help you navigate economic, geopolitical, and policy shifts and help your portfolio remain on track to achieve your personal financial goals. Coming up next, as the S&P 500 keeps going up, what can you do to protect some of those gains that you've made if things were to change? Find out. You're listening to the Protect Your Assets show. I am David Hollander, the Sandman. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known around here as the Sandman. And recently there was an article in the ARP Bulletin for January and February, which talked about annuities and the popularity of them. So whether you're considering an annuity as part of your retirement plan, maybe you already own one, or just wondering what they are all about, tune in for the entire show today as I will discuss 5 ways that annuities could help you. So let's start out with the first one. Do you think interest rates will continue to go down later this year? Well, you could be right. You could be wrong, of course. But if you've been following our market segment as we talk about rates and what the Fed's doing, we know they're keeping the economy under control and growing, and inflation not quite at 2%, but getting there. And that's because Chairman Powell and the members of the Fed have been on top of rates and have been lowering rates. They did it 3 times last year, and they just met this week, as I was discussing in the market segment. And it looks like right now they're just going to remain for a bit. But of course, there was just a nomination of the new potential Fed chairman, Kevin Warsh, who's a local Stanford guy. So let's start out with this. If interest rates were, say, to go up and not down, what would happen to the value of your bond portfolio? That depends. But typically, when rates go up, value of bonds go down. How much they go down? Well, that depends on typically the quality of the bond, the maturity, and typically for every 1% rise in interest rates, you multiply that by the end date of your bond, and that's how much you could lose in principal. So if your bond fund has an average maturity, say, of 10 years and rates were to rise 1%, then potentially you could lose up to 10% of the value of that bond or that bond portfolio. However, if you used a certain type of annuity, you could protect your downside. And that's something called a fixed annuity. You could structure annuity payments for a set number of years. And as a short-term or mid to longer-term investments, annuities could give you an alternative to bonds, CDs, and or other what you might call fixed income assets. And so you just want to compare the rates. Compare the rates to 1, 3, 5, 7-year bonds compared to some things out there called multi-year guaranteed annuities. And they're guaranteed, remember, by the claims paying ability of that insurance company. MYGAs is what they're called. MYGAs are typically tax deferred, so you don't pay tax on income you earn over the term until you start to take that money out. And then, of course, you'll pay ordinary income tax on that gain. Your principal, well, it's backed by the claims paying ability of that issuing insurance company. Think of it as a strategy to hedge against rate risk or market risk. If interest rates were to go down, well, you've locked in those higher rates now, so you'd be protected against that volatility, that drop in rates. And you could consider it a market hedge as well against something like the S&P 500 if that were to drop, because again, those are backed by the set rates that they declare when you buy it. It's a contract. What other types of indexed annuities are out there? Well, there's a couple now. The first one is called a registered index-linked annuity. These are called RILAs, R-I-L-A. And what they do is they link to stock indexes that generally have higher limits than, say, a fixed indexed annuity would. In return, you face the possibility of loss, though that loss could be limited in the form of what's known as a buffer. So let's say you had a RILA with a 20% buffer and your annuity had that protection on the 20% downside. So if the index, let's say the S&P 500 were to drop, say, 18% on the downside, you wouldn't lose any of your principal once again because that was backed by the insurance company. But if the buffer was 20% and the S&P fell, say, 25%, then the value of that investment in the RILA would be down that 5% differential. If the market does drop here in the future, how much would you lose? Think about that. Can you afford to lose any of that money that you've made over the last 3 years? Would that change your retirement date? Well, you should find out what that might look like by giving us a call right now and getting our checklist. Maybe it'll spark some things in there that you haven't been thinking about. And I'm going to email it to you this morning. Absolutely complimentary, but you have to give us a call to get it. So call this number right now if you would like this retirement checklist, 866-PROTECT. Call us, 866-776-8328. Again, to get your retirement checklist, 866-776-8328. Now, coming up next, it is time for our popular They Say segment, where they say when you die with an annuity, the life insurance company keeps all your money. Is that true? Find out. You're listening to Protect Your Assets with David Hollander. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman. And you're listening to Protect Your Assets this morning. And so recently there was an article out in ARP about the popularity of annuities. And as people are getting ready to retire, annuities could be part of your retirement. So what are some things you need to know? This morning we're covering the 5 ways that annuities could help you. And if you missed the last segment, I was talking about fixed annuities and then also something called a RILA. And if you'd like to know more about that, well, go check out our podcast. Where would you get that? Well, you go to your favorite podcast station, maybe like Spotify, and you would type in Protect Your Assets market segment, and you will pick it up right there. We are doing our Tax Smart Retirement workshops once again, and those are filling up fast. So it's great to see you all out there. We have some coming up this week. If you'd like to register, go check out our website where you can register right there. Go to libertygroupllc.com. You click on the events tab at the top. You'll see they are all over the Bay Area. We have different dates, times, different restaurants. Thank you to all the restaurants who do such a great job for us. We appreciate you guys and look forward to seeing you there. All right, so now it's time for one of our fan favorite parts of the show. This is our They Say segment where we debunk common myths, half-truths, and sometimes just bad advice. They say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that if you die while owning an annuity, the insurance company keeps all your money. Is that really true? Well, that depends. Most annuities, well, they're designed to leave a death benefit to your heirs not the insurance company. That all depends on the beneficiary form and also the type of annuity that you own. There are exceptions to that, though. And this is maybe where this "they say" came from. Let's say you took an annuity payout over a single life expectancy, meaning just you. And if you didn't have the period certain feature, well, then you might have a problem. So let's look at an example. And again, the example I'm about to share, this reflects a client experience. She was not compensated for it, and this experience may not be representative of all clients. Results are not guaranteed and vary based on individual circumstances. So let's take a look at Evelyn. She was looking to retire, and one of the pension options on her lump sum pension benefit was the benefit was to elect a either single person's life expectancy, or she could have tied it to her spouse. Now, Evelyn was looking to retire, and one of the options was a lump sum. That monthly income would be guaranteed for as long as you're alive, but absolutely nothing goes to the heirs if you were to select that option. Again, that was a single life expectancy. This pension is a type of annuity, and therefore, when someone finds out that they didn't collect all the money that their spouse or parent earned over their lifetime, well, you can understand how people might get excited about that. She called her financial advisor before she retired, and by structuring her pension properly, she was able to access not only the original principal, but if something were to happen, her spouse would get a payout in the event she didn't live the full term of the annuity. So if you're looking at a pension option, definitely give your financial advisor a call to see if there's something that's out there that might fit your situation a little bit better than what they're showing you. What's another type? So that would be number 3 there. That would be called a SPIA, single premium immediate annuity with a different payout option. So that's number 3 on the list here. Another option, well, that could be using something called a QLAC, QLAC. Let's say that you have to take your RMD from your IRA. Sorry for all the 3-letter words. Anyway, RMD stands for Required Minimum Distribution, and I'm sure you know what an IRA is, an individual retirement account. And let's say you had to take the RMD because you just turned 73. Well, you don't need the money. You don't need that RMD. And so, as you know, when you start to take it, it's part of your ordinary income, and that could increase the taxes you pay on your Social Security, on your Medicare benefits. There is a way to delay taking some or all of that RMD and protecting your Social Security and Medicare from higher taxes. It's called a QLAC. That stands for Qualified Longevity Annuity Contract. This is another type of an annuity. It's a special type of annuity designed to meet specific IRS requirements that you don't need to take RMDs on the assets in the QLAC. It is one way you can legally delay RMDs for a portion of your IRA funds and thus keep more in a tax-deferred environment to hopefully grow more. Right now, the rules are as follows. You can invest up to 25% of your IRA value. The limit is $200,000. You can delay taking income payments from the QLAC as late as your 85th birthday. That means if you have, say, $1 million IRA and you don't want to take your RMD, you could move $200,000 of it to a QLAC and defer any RMD on that money until you turn 85. Why else might you put an annuity in an IRA? Because remember, annuities are tax deferred, so are IRAs, so it's sort of a double benefit that you're not really getting a benefit, right, if you had an IRA to fund. Well, let's say you don't like market volatility. In the previous segment, I was talking about the RILA. Another type of annuity that ties itself to indexes is something called a fixed indexed annuity. Now, these typically offer higher upside than, say, a fixed annuity would that just has a declared interest rate. They typically pay a fluctuating interest rate pegged to an annual percentage change of an index. So let's say we looked at the S&P 500. The worst it could do would be 0 on a year when the S&P was negative. The best it could do, well, you get a portion of that S&P 500 upside in return for protecting against losses of your principal. So here's what you need to know. In exchange for getting that protection on the downside, and again, that protection is backed by that insurance company's claims paying ability, you're giving up some of the upside and potentially dividends that would pay on that index as well. So what are some terms you want to look at if you're looking at something like this? Something called a cap. A cap is the maximum rate of interest that you could earn in that annuity during that S&P 500's term that particular year. So an example, the annuity could say that on the S&P 500 for year one, there was a 9% cap. So if the index goes up 8%, well, you'd get 100% of that 8% return. And the insurance company in that case would get 0. If the index, say, goes up 18%, then if you had a 9% cap, they get 11%, and you would get 9. But let's say we have another 2022 and the index drops 20%. The S&P 500 drops 20%. What would happen to your deposit, plus all the gains you've been making these years or those years? It's a good question. Well, you wouldn't lose any of that. So in that case, you would get a 0. You would still keep your principal plus the interest you'd earned in any years you were in there. And even if the index was down 20% or worse, then you would still have everything you had that previous year. So that's where they protect you on the downside. But again, you would potentially be giving upside as the market were to go higher over future years, if that's what happened. There's also something you want to pay attention to called a participation rate in these fixed index annuities. And that par rate, as we call it, determines what percent of the increase in the underlying index would be used to calculate the total return during that index term. This could be, again, it could be in addition to the cap. It could be just a separate declaration of interest. That's why I have to pay attention to these things. For instance, let's say they say, the insurance company says, we will pay a participation rate of 70% of the increase of the S&P 500. The S&P 500 for that year goes up 10%. So you would get 7%, and they would keep the 3%. And that 7% gets locked in as in addition to your principal. And so the next year, if things weren't so great and the market went down, well, you'd still have your principal and that 7% that you'd earned the previous year. Make sense? Sure. So some of the benefits overall of annuities, again, this is just a high level. If you're looking at a fixed indexed annuity or a RILA or a fixed annuity, as we've been talking about this morning, they could pay more income than you might get by investing that in something on your own. That's because annuity buyers who happen to die earlier than expected indirectly subsidize annuity buyers who happen to live longer than expected. It's sort of like your fire insurance. Remember, those claims are usually paid by premiums from homeowners who don't have claims when your house burns down. What are some of the downsides? Well, gains, as I've been talking about with an FIA or a RILA, those are typically less than the stock market total returns over time. If you were to invest the same amount in a mutual fund or ETF or stock, you're giving up upside, of course, for downside protection. But like I've been saying, they could produce better total returns overall if you were to live longer than others, as you compared it to, say, a bond. In addition, some of the things about these indexes you need to know is the dividends are typically not paid into the policy. So yes, you get the upside of the market. And if it's a RILA with a downside cap of 20, remember everything past that 20 you would feel. but you're also not going to receive those dividends paid off of, say, an index like the S&P 500, which again, over time, does contribute to the total return. Once you buy an annuity, receiving your money could be costly. Surrender periods, they could range from 3 to 10 years. And if you needed to get more than, say, 10% out of that annuity, look for the withdrawal features on them. You could end up paying a penalty. And that's because you were to cash out early from what you originally signed up to do. Of course, annuities also bring ordinary income. So any gains you make will be taxed as ordinary income as opposed to capital gains. Do you ever wonder if your retirement savings would last as long as you do? Big question, right? If you saved enough to have the continual income that you're going to need that will keep pace with inflation. Well, if you're thinking those kind of questions, you're not alone. According to a survey done by Allianz, the vast majority of Americans fear running out of money in retirement, get this, more than they fear death itself. So if you have this fear or any questions around that, then get a copy of my book, Protect Your Assets. In it, in Chapter 3, I talk about these sort of things. If you'd like a copy of that right now, we'll email that to you, but you have to give us a call, 866-PROTECT, to get your complimentary copy of Protect Your Assets. Call the number 866-776-8328. Again, 866-PROTECT to get a copy of my book right now. Keep it tuned right here, because when we come back, find out about the costs associated with annuities and one mistake you don't want to make when you list your beneficiaries.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman around here. You are listening to Protect Your Assets, and this month there was a great article in the ARP Bulletin talking about the popularity of annuities. And that's because people are retiring and they're wanting to protect some of that gains that they've made in the market all these past really good years. And so they're wondering how they can do that. And so annuities are becoming popular again. And so this morning I've been covering 5 different types of annuities and things that you could do to use them to help you in retirement. And those were the following. We had fixed annuities. We talked about fixed indexed annuities. We talked about RILAs. We talked about QLACs. Yeah, I threw one in there called MYGA. And today we're talking about annuities and how those work. And you should just know a few things about them before you get into them, obviously. So previously I was talking about fees. And let's talk about that. So insurance companies, of course, are in the business to make money. And there are fees in annuities, even if you don't see them. So I haven't really discussed variable annuities, and there's a lot to talk about when it comes to that subject. So please get a copy of any prospectus before you were to buy one or look at one, because those have great information in them. And in them, there is something called a fee section. And so when you start looking at that, you'll see admin fees. There's fund fees. There could be a company fee or a rider fee. These are all fees you want to add up. And make sure you look at them to see what they would be each year before you made or broke even on any of your money that was invested in something like that. Been spending a fair amount of time on fixed indexed annuities and fixed annuities this morning as well. And so those typically have the fees built into them before the rates that they quote, because there isn't usually a fee that is deducted out of that profitability before you see it. So again, read those, understand what they are, how they work, how they come out, what that looks like. And if you're looking at something like a MYGA I was talking about earlier, MYGAs, again, multi-year guaranteed annuities, guaranteed by the claims paying ability of that insurance company. They declare a rate. So there could be a 5-year MYGA right now. And that rate that they quote, that is the rate that you would make. It's net. It would be the net rate of all fees that you would collect each year on your principal. And remember, those are tax deferred. So you wouldn't pay taxes on that interest until you decided you wanted to take it out. Now, when you buy an annuity, you're going to be required to name a beneficiary. And this continues to be an issue that we see here. People own annuities, they pass away, and then their beneficiaries say, well, why didn't I get it? I'm his wife. I'm his kid. What happened? The beneficiary designation on the contract controls. So even if you have a will, even if you have a trust that says something different, sorry, that annuity form will control the disposition of that money. So if you named your spouse as your sole beneficiary upon your death, your spouse would collect that money. And they should be able to roll that over to say a spousal continuation option. So again, the taxable portion of that would be deferred until he or she started taking that out later in life. If beneficiaries like your kids aren't named on those contracts, they don't automatically just get it. Doesn't work that way. And of course, if they were to receive the beneficiary, because let's say they were the beneficiary and they receive the value, they typically, and of course, they're not the spouse, so they're not going to get that same sort of benefit. They're going to have to pay taxes on that income as they take it out on any gain that was there. So if you haven't looked at this for a while, I would encourage you to do so. Take a look at your beneficiary designation form. Make sure it's current. Make sure it's filed with the particular company. Because if it's not, what will end up happening is you could end up in the probate court. In other words, if there's some confusion about who the beneficiary is or who the insurance company is going to pay out, do you think they're just going to pay the money out to someone who says, well, I'm entitled? No. They're going to say, sorry, you need to go to the probate court and let the judge figure it out and then come back to us with letters that'll tell us what we're supposed to do. Okay? So if you have anything like that, including a life insurance policy or a retirement account, then I would suggest at this point, make it a priority to pull the form that's filed with that company. Make sure it's correct, make sure it's what you want, and then put it with your important papers that your children or your spouse would look at in the event something happened to you. That's called estate planning. And we are attorneys who do estate planning, and we help you think about things like this. I hope today you learned something from the 5 things we were talking about with annuities, but if you'd like some help, you want to explore some of these new products like RILAs that are out there, or MYGAs, don't put all your eggs in one basket. Diversify, hedge, use the strategies that are out there right now. That's where we come in, because our mission at the Liberty Group, well, it's to help you protect and keep more of your money so you can enjoy your lifestyle in retirement. It helps to generate a plan and to look at your situation as opposed to going it blindly. And if you need someone to talk to, call us, 866-PROTECT. We're here, 866-776-8328, 866-PROTECT. I'd like to give a big thanks to the entire Protect Your Assets crew for putting together a great show today. My executive producer, network manager, Kevin Renfer, and of course, all my fabulous producers back there, Raph, Dylan, Zach, because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You are listening to the Protect Your Assets Radio Network.